The thing I would really worry about is, going back to the parallel potentially with 2006, if we were in the same situation with the credit markets and the way banks and the credit markets actually operates. We've put together what we call a capital market dashboard, in which we have literally three buckets. The first bucket, where we try and measure imbalances, is the demand supply for space. It could be office space, could be it's the economy. It's who actually needs space, from residential to retail, logistics, offices, etc. And then we have the sort of the debt imbalance, where we're seeing capital flows being driven essentially by equity or by debt. Is it the banks actually creating that asset price increase, or is it equity looking for assets? And lastly, the pricing imbalance, where for example, you have a yield in property that is actually offering a good yield premium relative to other asset classes, and bonds in particular. At the moment, if I look across the world, and our colleagues in America and Asia Pacific are doing exactly the same thing as we do here, one of the really things that we've picked up is that the first bucket is not imbalanced. Demand supply, we're not seeing overly supply-driven markets at the moment. In the debt space, there are some markets where there are some caution flags. For example, in Germany, with the Pfandbrief market, we are seeing LTVs go up to 70-75% levels, whereas we are not seeing this in the UK at the moment. So, if you just those flags that we just inform our investment committees. And then in the pricing, this is where, the pricing is actually the one where we have more caution or red flags, going back to the cycle point I was making earlier. So that's the one today I'd like to worry, or I'd like to have the fund managers worry about the risks that are actually out there. The unknowns, I think it's just, what would you do if you just be prepared? You can't know, right, what's going to happen. So, however, there are a number of things that are out there, pretty visible, and you need to prepare for those. Bring your leverage ratios a bit down, even if it's tempting to put more debt in place. Make sure your capital needs and capex are planned in terms of capital expenditure plans. Those are very basic things just to keep your assets prime or core.
Can I just pick up on that point? I mean, I agree with Mahdi that what's different between 2016 and 2016 is the kind of absence of the madness on the debt markets. I mean, that's clear. But can I just say there's still enough capital around? I mean, in the core markets around the world, you see good Class A assets oversubscribed 10, 12 times still. I mean, maybe not so much in London anymore these days, with all the oil money sort of being repatriated and the uncertainty about the future of the UK and the European Union being there. But in other markets, go to Manhattan, it's still madness. You have 10, 12 times ready capital to invest for the one asset. For us, therefore, in given that there's so much capital around in Union investment, risk management starts with liquidity management. On various fronts. If I could just make that point, first of all, when we take money into our open-ended funds, we don't mix retail money with institutional money, as some of our competitors have done, and they're all now gone. It's now virtually a reconciled market, a consolidated market. There's an oligopoly in place, because those who have mixed the two sources of capital have gone into illiquidity. Secondly, we don't even take liquidity in over a certain threshold. We actually stop selling units of our funds, because I mean, that's leaving money on the table. That's actually stopping your business in terms of bringing money in. But we don't want to be diluting fund performance for those existing investors on the one hand. On the other hand, we don't want to be under pressure to invest simply because of that dilution happening, and we have to buy it, because then you make unwise investment decisions. And then you look at all sorts of other levels of liquidity management when it comes to the minimum liquidity requirements, and some layers on top of that, simply because you're open-ended and there may be redemptions. Because if interest rates go up, and there's nothing in sight yet, but if they go up, maybe our return on an open-ended real estate fund looks less attractive than something else. And if money is being reshifted, you want to be liquid enough. So liquidity management in times of abundant equity around in the world is a major theme, especially when you have distorted interest rates like this. I mean, Japan in negative interest rates, Super Mario at 0%, European Central Bank. Where does this lead to? I mean, I was at a Japanese panel this morning, was half asleep, it was 7:30. They were talking about the Bank of Japan making an experiment experiment with the Japanese and global economy by testing out what's going to happen if they have negative interest rates, because they've got no idea what's going to happen. So that's a scary time. So that actually leads to misallocation of money. That's why you should say stop before money gets misallocated.